Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets, from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Henry. It's fantastic to have you on the podcast show.
Thank you very much, Bilal. It's great to see you again. It's been way too long. I'm excited to chat.
Great, likewise. And now, before we go into the meat of our conversation, I do like to ask all of my guests something about their origin story. So what did you study at university? Was it inevitable you'd end up in finance? And what are some of the key career milestones that you've had over your extensive career?
Absolutely. So I tell this and people sometimes are quite surprised, but I went to a liberal arts college and I majored in history. And I thought for sure that I'd become an academic and never did I think I'd end up in business. But after writing my dissertation, we had to write a dissertation equivalent where I went to college. I thought I needed a break. And so I looked around for something. I also was in debt. I think I had, I think I graduated with something like $20,000 of debt in 1985, which is the equivalent of whatever, $120,000 these days. And with a history degree. So you can imagine there was a bit of pressure for me to perform. And so as I thought about what I do for a couple of years, I became very interested in working in banking and finance. And I didn't graduate with a job. I actually graduated and traveled the world for a little bit and thought about life, and started working in the analyst program at Credit Suisse First Boston, sort of off cycle in February of 1986, and just had a great experience. I had good mentors there. I learned a lot. I was in the restructuring group, and we spent all of our time dissecting the asset side of the balance sheet of failed or failing companies and figuring out what was worth keeping and what wasn't strategically, and then working on the liability base that resulting asset could support. And
this was the companies on the balance sheet of Credit Suisse, like loans they'd given to companies?
No,
or
these were for the most part companies that had come to Credit Suisse First Boston for advice. So I was in the corporate finance
from
division.
that side. Okay, yeah.
And so I was working on, at that time, it was a lot of oil and gas companies, famously, a couple of asbestos companies, some nuclear power plants, things that had, great, potential, steel companies, coal companies, but had not been run with the right, fundamental cost base in mind, or had been hit by exogenous events that were simply out of the control of management. And it was just a fantastic learning experience. And I did that, and I was kind of hooked from there on, and so much for the academic career. I was also, believe it or not, very, very interested in fencing. So I was a top ranked fencer in the United States. And so I was also at the time thinking, maybe I should go for the Olympic, team and so on and so forth. I could have done that in New York, but I gave that up as well. So I gave up the history career. I gave up the fencing career, and started focusing on finance.
And just as a side note, what did you find so interesting about fencing? That's kind of an unusual sport. What did you like about it so much?
It's a really fun sport. It's one of those sort of niche things that not too many people do, so it's kind of fun to talk about. But also it appealed to a very strong competitive streak within me, and it's technically very difficult, physically very demanding. I'm not sure if you've ever tried, but spend 2-3 minutes on the fencing piece, and if you've never done it before, you're exhausted. So quite a fun sport, and very, very competitive. So I have to be a little bit careful when I pick up the foil. I used to fence foil, I have to be a little bit careful when I take up the foil. But really, just a great way to learn about, about your own personality and what you do and what you don't like to do. I always say to people, and we can talk about it later in the podcast, that life is all about finding out what you don't want to do. But there are a lot of things that you like that kind of, unfortunately, fall by the wayside. As you winnow your way towards, figuring out what you really want to do in your life. Anyway, that's a side note. But after Credit Suisse First Boston, I spent a year in Indonesia on a fellowship program with the Luz Foundation, which we can talk about. I had great experience in Jakarta, and then I worked before coming back to the United States for business school at an M&A boutique in Japan. I learned Japanese. So I already spoke Indonesian after preparing for and then living in Jakarta and traveling in Indonesia. And then I went to Japan, learned Japanese, worked in a small M&A boutique, which is a spin-off from MHC Securities. Really interesting experience, fascinating experience. And I was there during the major crash.
So this was in the early 90s then, was it? Kind of after the bubble?
Yeah, 1989.
Okay, 1989. Okay, just as the economy was crashing.
Just as the bubble was bursting. Yeah. No, when I arrived in Japan, it was still, gold face and, sushi and sake. By the time I left, it was, it was rice balls and seaweed. But, but fascinating experience. And then I went to business school at the University of Chicago and met my wife, had a great time there, learned a lot, got 2 degrees, one in East Asian studies and the other in business. And then started working at Merrill Lynch in New York on their trading floor, which was a real fun experience. And it actually was a great switch for me because I'd spent a lot of time in corporate finance and sort of consulting longer term projects. And I really enjoyed the much faster turnaround time of sales and trading. So I started covering hedge funds out of New York, and I did a lot because I'd spent a lot of time in Asia and in Europe growing up. My then boss, Anshu Jain, who ended up becoming the co-CEO of Deutsche Bank, said, "Henry, you can do the night shift." So I would come in at 3 or 4 in the morning to focus on Europe, and then every other week I'd switch and focus in on Japan. So stay late at night and focus on Japan. Great experience.
That really probably affected your circadian rhythm, I imagine.
It was not easy, but it was a fun experience. I learned a lot. So I spent a lot of time, learning not just the U.S. markets, but also the Asian and the European markets. And it was fascinating to cover the hedge fund client base because at the time it was the start of Tiger and the big macro hedge funds. Now those places have become very institutionalized, but at the time most of the investors were private individuals, not institutions, and they could take a lot of risk across multiple different markets. So we were trading fixed income primarily, but doing a lot also in commodities, foreign exchange, all sorts of products. And the macro hedge funds were more interested, of course, in the broader themes, but they depended on us for advice as to how to articulate their views. So if they wanted to be long, 5-year, German, bonds, what was the best way to do that? Was it to swaps, futures, individual, bonds? How much size could they do, and so forth? So it led naturally to a lot of interesting discussions around, richness, cheapness. We were covering long-term capital as well, all that kind of good stuff. But after a couple of years at Merrill Lynch, Edson Mitchell, Anshu Jain, a number of other folks decided to join Deutsche Bank, and they recruited me. And I left New York to go to London, and my wife and I worked in London for a number of years for Deutsche. I was focusing on hedge fund coverage, and then after a period of time, onto and Colin Grassi, Jonathan Paul. I'm not sure if those are familiar names to you.
Absolutely,
they were,
yeah.
running sales. They asked me to go to Asia, and so I covered Asian clients out of Singapore for some time. So I ran the sales business for Deutsche Bank, covering
Just out of
everything.
interest, I mean, you were covering clients and sales in New York, London, and then Asia. In broad, I mean, this is always hard to do, but in broad brush, what are the cultural differences you found in those, either in terms of managing teams, like internally, and then also when you engage with clients? What are some of the differences you find? I mean, if we take the extreme, say US versus Asia, to kind of caricature things.
Yeah. I mean, I don't want to overgeneralize or oversimplify, because that's super dangerous. I think the best way to manage people is to focus on their individual needs rather than, focus on group. But, I would say that the United States, the folks I was managing there were much more self-directed, very keen on ensuring that they had their list of clients, and that's what they're going to focus on. Their mandate was very clear, and that's what they're going to do. And it worked, right? In the European situation, a little bit more consensual, a little bit more focused because of the perspective on client management holistically. I'm overgeneralizing because we have some great holistic client managers in the US as well. Nancy Donahue comes to mind.
Okay, I remember.
But the nature of the European markets forced people to be a little bit more generalists, because they had to go across many different countries and more products. Whereas the liquidity and the depth of the United States made, for much more product focused, individualized coverage. And then Asia was like even more of an extreme. You had to be super generalized. You were doing everything for a client, from foreign exchange to money markets to helping, them figure out how to hedge some of their interest rate risk. I mean, you were doing everything because the wallet size was smaller, the markets are smaller, and people really needed to be more team oriented there, because it was impossible for one person to be a product expert across so many different things. I'm completely overgeneralizing.
Yeah, of course. Yeah.
Hopefully that gives you a little bit of context. But I enjoyed all those different roles. I found Japan probably the most challenging, because even though I speak Japanese, it is a very specialized market, and by the time I got there from Singapore, there were a lot of regulatory concerns around marks to market on credit products, and we were just starting to go through the credit crisis of 07 to 08, and the nuances of how to mark positions to market, mark positions to liquidation value, mark positions to theoretical fair value. I mean, that kind of got lost in the shuffle of the discussions with the regulator. But it was a super learning experience. And when I was in Japan, I was running the whole country, not just sales or trading. So I had a much more senior position. And then I left Asia to come back to London in the midst of the financial crisis. I think in March of 08, I came back to help Bill Brooksmith and Anshu Jain sort of focus on restructuring the business and markets, and prepare for an environment where regulatory, risk weightings on assets change quite dramatically. So, I mean, we forget sometimes that in that 2008 period, we were dealing not only with significant market risk, but also with significant regulatory change. And all of a sudden, banks under the prior regulatory regime might have had a capital ratio of 5%. under the new regulatory regime had a capital ratio of 1%.
Well, that's quite a big change. And so you have to find the capital.
That's the reality.
You have to somehow.
That is exactly the reality of what was going on. And, European regulators did not have the nuance or the finesse of the US regulator in managing that process. And so to your point, in that period from 2008 to 2009, one of the reasons I came back is because we required radical surgery on the balance sheet, and anything that was lazy, sort of 25 basis point or carry risk, got jettisoned, and a lot of complicated, derivative products or, difficult to mark, illiquid products just had to go. And I think that was one of the driving forces behind, the sell-off in asset prices, later into early 2009. But good learning experience. And after doing a lot of work restructuring the balance sheet in different businesses, I did work in the same in transaction banking and corporate finance. So applying some of the learnings that we have on the market side there. And then life changed dramatically when I'm sure Jane and his co-CEO Jürgen Fitchen asked me to join the board. And I was on the board of Deutsche Bank from 2012 to 2015, focusing on big picture strategy and asset allocation issues, as well as much more detailed, nitty-gritty operations, technology, management of the real estate footprint of the bank, and so on and so forth. Again, quite different from what I'd done before, but really good learning experiences.
I mean, I was obviously at Deutsche Bank at the same time as well, and we kind of worked on the same floor for a period of time when I was working for Anshu. One of the things you always have within any company is that you think, why doesn't management just do X, Y, Z? It's so simple. They should just do this, like just cut this region, focus on this product that's not so balance sheet intensive. When you're in the board position, you're a COO, obviously, a very sort of senior C-suite position. What do you find is the constraints? I mean, what do people not realize? From without, from someone like you as someone who's done the job.
So some things are simple and easy like that, and so I was a big fan always of sort of what's known as pizza box meetings, having just enough people in the room to be able to share a pizza to make decisions, and that can be done at multiple levels in the organization. Big fan of that, and sort of decentralizing all those decision-making processes, I think, as much as possible is the right thing to do. There's no doubt about it. That presupposes, though, that you've made key strategic decisions about which businesses you want to be in and which businesses you don't want to be in. And now, so I'm going to extract from Deutsche Bank and think more generally about the European banks, because it's not fair just to say this about Deutsche Bank. But I think all the European banks have a very significant, issue and have had since 2008, 2009, which is they're trading at a very significant discount to book value. And so you have to ask yourself, this has been since 2008, 2009. This is not like a short-term thing, right? This has been going on for a long, long time. So you have to ask yourself, so why for 2-3 generations of banking and banking years, this is 2 or 3 generations, the banks just don't trade at book value. It's obviously not the marks to market of the positions, right? And not after 15 years. After 15 years, obviously the marks are good. That's not the issue. So the issue is not asset quality or marks. I think the issue is much more one of focus and scale. And so to answer your question more directly, I think the reason that people don't do the obvious things is because there's certain businesses that if you're going to be in them, there's this minimum, criteria, minimum requirements. And that can be anything from certain geographic footprints to certain investments in people, regulatory licenses, technology and operations infrastructure, and so on and so forth. So the easiest and the simplest thing to do, it's super easy to say, it's just very hard to do, is decide which businesses you really want to be in, which businesses you don't want to be in. And that's, and that's great and easy and simple. But the reality is that, Europe is still not a single banking market, right? Bankruptcy law is different in every country in Europe. Capital markets laws, completely different, right? Consumer and corporate lending laws, completely different. So it's not like the United States where, so by state, there'll be some variations. There's certain usury laws in certain states, certain twists on the banking, regulations in certain states. The banking regulator in New York, tends to be much, much bigger than the banking regulator in Nevada, stuff like that. There's some conflict between, the SEC and various other, regulators, and, that little argy-bargy. But that's quite simple in the context of what's generally accepted to be a large, homogeneous banking market. It's just not true in Europe. And so you're forced either to run complexity of regulatory relationships across multiple jurisdictions with one product focus. You're going to do retail across all of Europe, but you can't depend on one regulatory environment. You've got multiple regulatory environments, right? I mean, even to the point where, you have to worry about, I don't want to overdo it, but you have to worry about if you're going to do consumer lending in Poland, it's very different from doing consumer lending. It's a different law to do consumer lending in Germany, right? Just hop across the border in Poland, hop across the border, it's easy, right? So it's kind of crazy, right?
But I can see your point. So just the complexity levels are just so much higher in Europe because of the fragmented nature of the market there.
That's exactly right. So what ways can you create competitive advantage of a bank, right? You can specialize in one product and one type of client base, or you can specialize in having a certain regulatory relationship, right? I would argue that certain banks, their raison d'etre is they really understand the regulatory environment in country X, right? They understand all the regulators that country X, and so therefore their raison d'etre is to focus on country X, A to Z, everything that can be done with clients, in country X, right? And that's frankly, in some ways, a little bit easier than having 20 regulatory relationships across 20 countries. I mean, this is one of the reasons why I think we're seeing certain banks, pulling in their horns from the geographic perspective, right? So I've given you a long, complicated answer, but I think, just generally speaking, and I really want to emphasize this should not be, focused on Deutsche Bank, but the whole of the European banking market needs to either push incredibly hard for a European-wide, bankruptcy and capital markets / lending laws, right? Option A, or option B, just decide brutally, like, I'm only going to do this, right?
And going back to your point about scale, obviously for scale, you want to be big. You want to go across all countries.
I agree, but I mean, but let's be.
But
really
you may not get economies of scale. I guess it's not the same. Big doesn't necessarily mean economies of scale, I suppose, because of the
you get certain advantages. I agree. You get certain advantages from a product perspective, right? So deposit taking in Germany is not significantly different from deposit taking in France. Okay, but how many French banks have done really well in Germany and vice versa?
Yeah, that's fair. Yeah.
That's the reality of life. So So I think absent Europe-wide, banking laws in general, so bankruptcy lending, blah, blah, blah. I just don't see this changing. So it's a bit of a waiting game. The banks have been very patient. They've been sitting there since 2008, 2009, trading at significant discounts to book value. That hasn't changed.
I mean, I have to say that's quite remarkable. I always thought we'd go back to trade back to book. And initially I thought, okay, it was maybe some poor marks on the book. So maybe the market didn't believe what the mark to market was. But as you said, I mean, after 1 or 2 generations of people going through a couple of business cycles within there as well, it's the same, all European banks trade at discounted to book.
Yeah. And it's very inefficient. So, I mean, if you look at, I forget the numbers off the top of my head, but, but order of magnitude, since the savings and loan crisis, we probably have clipped off half of the banks in the United States, maybe more. And in Europe, that just hasn't happened, right? Not nearly the same sort of scale. And so you end up with, sort of regional, you've got a couple of big Nordic banks, you've got a couple of big French banks, you've got a couple of big German banks, and so on and so forth. And then if you're a German regulator, I mean, do you really want, the top 2 or 3 banks to merge? That's like, potential disaster, because the reality is that, because of the market positioning, and because of the law and just, inertia and the difficulties of dealing with cross-border, banking. It's a really tough decision, really tough issue.
Now, I do want to go to your post-banking life as well. But before we get onto that, just another question on the banking side. Many European banks have tried to crack the US market, but they've really found that very hard to do. There's been periods where they have started to be dominant, especially things like fixed income, less so equities, but they've struggled to keep a foothold in the US. Why do you think that is?
Or
maybe it's not a fair characterization. Maybe it's,
I would say it requires a little bit more nuanced view. I think some banks, some foreign banks have done really well in the United States. And I tend to agree with you. It's more on the fixed income side. But, U.S. banking law and the U.S. tax code is really designed to encourage non-U.S. institutions, individuals to lend money into the United States, right? It's not a bad tax code if you want to borrow money from overseas. So the U.S., because it's as one of the perks of seniorage, can borrow money very cheaply, and the tax code actually encourages that. And as long as the U.S. remains the imperial currency, as somebody reminded me in Argentina not too long ago, when I asked if I could pay in dollars, the imperial currency, of course. I think foreign lenders will do well in the United States. So I think it's a bit more nuanced. Now, how hard is it to build, as a foreign institution, how hard is it to build a U.S. banking presence more broadly? I think it's not easy, because you need to have the right cultural, sort of paradigm. When I started this conversation with you, we were talking about sort of generalized approach to managing sales in these different, locations. The United States is much more complicated, it's much bigger. It needs scale, it needs specialization. Just the mortgage market is huge, right? And you have the treasury market, and then you have the equity markets. You've got the corporate hedging markets. there's so much specialization required, and therefore, whatever foreign bank, whether it be European, Japanese, we've seen lots of folks involved. They need to create a culture that allows, the local management team to really build that, specialization out bit by bit, and to stick through it through various cycles. So I'm a bit more optimistic about that than maybe some others might be. But there's no doubt that there's huge home advantage if you're a JP Morgan or a Bank of America. The deposit base gives you such cheap funding. It's what do you do, right? I mean, that's an incredible advantage, right? If you're a Goldman Sachs, the corporate relationships that you've built up, over generations, it's an incredible advantage.
Yeah. And we might come back to some elements of what you did at Deutsche Bank, in particular on the digital bank. But after Deutsche Bank, you then changed tack career-wise. Can you just touch on some of the things you've been doing since then?
Absolutely. So, I spent a lot of time thinking about whether I wanted to be operating again or investing. And so, using that lens, I decided that I had enough of operating things. I'd done a lot of operating. And so I started investing. And that was, I spent a lot of time talking to people I really respect about this. Most important, my wife, because, I was taking some pretty significant risk. So we decided that we would run essentially a family office type of structure, not take any money externally, but to take significant risk in startups, particularly fintech, which I felt like I understood based on the experience I had at Deutsche Bank, not just running the bank, but also, as you mentioned just now, starting a lot of the digital banking initiatives there. So one leg of the strategy was focusing on investing equity into early stage, what's been commonly described as fintech company, but I think it's a bit of a generalization. Another leg of the strategy was to, and remains, both these strategies remains to invest in lending to early stage startups, not lending as in Silicon Valley Bank, sort of venture lending, but lending against hard assets in special purpose vehicles. So using, ABS technology and, structuring to provide lending to early stage lenders, so to allow them to grow a balance sheet or other asset rich, startups. So first leg of the portfolio, highly focused on growth. The average holding period, is 12 to 15 years. You have to be willing to sink money away for 12 to 15 years, not see any cash flow out of it. The second leg of the strategy was very focused on generating cash flow, monthly cash flows, highly secured, relatively low credit risk, believe it or not, because structured to ensure
I guess, is
over collateralization.
Yeah.
But the real risk you're taking there is what I call startup risk, but that includes a whole range of things, like how quickly, if you provide, a borrower a credit line, how quickly will it take it down, right? What kind of operational risk is involved? Fraud, right? All these different things in a startup environment, which are much trickier than in a regular credit environment. Okay. So you're not necessarily taking just credit risk. I mean, in fact, I would argue again that the credit risk was relatively low. You're taking a lot of operating risk. And there I did a lot of work with a partner who had been on the board of Credit Suisse. And so he and I have done a tremendous number of those sorts of transactions. Focusing on UK and the US, we developed a number of partnerships now. So we're less, hands-on, but but we're still doing those sorts of lending transactions. And then through time, and particularly after the when we had COVID and afterwards, we've also been building a public equity portfolio and a public debt portfolio, focusing again on high yield, and we have a real estate portfolio as well. So those are the sort of the pillars of what we're doing. The focus, particularly since COVID, has been on how to generate cash and cash flows. I was very worried, and remain, still worried about inflation. Even during COVID times, I was like, oh man, this is not good. We really need to focus on cash flows. So we lightened up on the pace. We slowed the pace of investing in growth equity and increased the pace of investing in inflation hedges since COVID times.
Okay, understood.
But hopefully that gives you a little bit of perspective.
Yeah, no, that's fantastic. Yeah. I guess, one question is, you've obviously run as an operator when you were at a bank, you ran very successful teams, divisions, and so on. And then you've gone to the other side and become an investor in startups. And with many of them, you've held them for a long period of time. On the startup side, do you find that the successful companies are similar to successful teams used to manage within a bank? Or, what are the different kind of markers of success? Because when you build a team within a bank, there's obviously certain things you look for, but then startups is different culture. But then is it different or not? In the end, it's just about execution.
Yeah, so that's a great question. I think it's a bit horses for courses. So in my experience, very early stage startups, the mentality's got to be very different. And it's, I spent a lot of time at Deutsche Bank trying to instill that mentality into teams when they were going into new markets or new products, or they're fixing really thorny issues that couldn't be fixed in traditional ways and needed to be fixed in unusual ways. What does that mean? You need to have people who think outside of the box, who don't accept the status quo, who, don't need to come in, in the morning to pick an agenda, right? So I'll make it a real extreme. If you're covering, a client for, interest rate derivatives, right? And you've got that client and 5 other clients, and they're trading, 100 times a day. You have no time during your day to do anything else other than to focus on that client and do an excellent job at it, right? So trying to take that person out of that job and put them into something different, or try to take that person and encourage them to think about how to do things differently and more efficiently, is hard, right? It can be done. And the best ones, do that, right? The best ones, they master it and then they figure out how to do it even better, right? And they have to figure out how to even do it better, right? They're constantly applying, the lifelong learning to improvement. But there are not too many people like that, right? Most people who do a really good job at focusing on, a particular product with a particular type of client base, they're good at it because that's their mentality, right? And it's hard to get people who are good at that kind of consistent performance, as well as thinking outside the box. It's just different personalities, different way of thinking about things, let alone the time. So it's an issue of time and focus, but it's also an issue, what kind of think you are. So in the horses for courses, response, I would say that, for early stage startups, you need a very different type of mentality. People who are comfortable with big risk, just not having a set agenda, thinking outside the box, who are comfortable with the scientific method, right? Just experiment, try, it doesn't work, do something different, right? It's amazing. It reminds me of the famous thing from Albert Einstein. Just because you failed the first 99 times, doing it the exact same way.
Yeah.
But, trying, quickly failing is much, much better than, trying 20, 30 times. Try, fail, move on. And so the process of decision-making needs to be sped up in early stage, firms. And there can't be very much oversight. I mean, you have to be really comfortable with like just letting people go, like the fast and flowers bloom strategy. And so that mentality, though, has to change as the startup matures. And that's a combination of starting to institutionalize certain practices. So you've experimented with 1,000 different things and you found one or two that really work well. But then you've got to start thinking, okay, now I need to bring in the people who are good at just optimizing that one or two things. And then, right? So, so I don't think it's necessarily like, differences in culture and people. It's just what's appropriate for a particular person at a particular time, or what's appropriate for a particular company at a particular time. And I think that nuance is what separates the really successful startup operators through time. They get that. So they know when they need to, start to create structure and process and discipline. And when you just let the horses run, right?
And, one of the things we found until very recently was that we had cheap money, since COVID, not since COVID, well, COVID, but before that GFC as well. And so you found that startups were doing fantastically well, tech was doing super well. It didn't matter if the company was making profits or not, it was about revenue growth, valuations were astronomical, unicorns and all those sorts of things. I mean, how do you think about that sort of regime? Because obviously, to some extent, you could argue that what worked in that period is not going to work today, but many people are, trading off the back of that reputation that they had of being amazing VC investors. But was that just cheap money or not?
It reminds me of a famous cinema company startup that Matt Levine likes to write about it in Bloomberg. Just raise a bunch of money and then use that to subsidize your product. Look, there's a lot of that stuff going on. Okay, so let me just take a step back. So I think the post-financial crisis period up until, maybe last year, and even then, we've had, almost 2 decades of negative real interest rates. Almost 2 decades of negative real interest rates. I think the last time that happened, and I have to check, I think that was sort of 1870s US. I don't even think we've had decades of negative real interest rates in the UK. UK has been much more reasonable about that stuff. But that gives you a sense of how unprecedented negative real interest rates are from a historical perspective. And it creates huge distortions. I remember calling up a major life insurer who's a big player in the German government bond market. And I spoke to the person who's responsible for their entire portfolio. And I said, why are you wasting your time buying negative nominal and negative real yield? Forget about negative real yield. That maybe through time changes, blah, blah, but you're buying negative nominal yields. You are essentially telling the people that you're managing their money for that you are locking in a negative return, right? And the answer was, well, regulatory reasons. I'm like, well, go fight with the regulator, take them to court, right? Why should you be buying something at 100 cents on the euro that is going to return you 50 cents on the euro? How is that possibly the right thing to do for your customer base? You have a fiduciary duty to your customers here. And he's like, I can't, I'm not going to waste my time doing that, right? So that's just one example of so many that I can give you of how distortionary this, period has been. I think that led to a whole series of overinvestment in many different types of products. There were certain governments who were really smart and locked in long-term money. I had to chuckle about the Austrian 100-year bond.
Yeah.
Um, it's shocking to me that the United States didn't do that. I think 80% of the debt in the United States matures within the next 2 years, when they had opportunities to issue, 30-year govies in just shockingly low yield. But put that aside. I don't know yet the extent to which that distortion will cause future problems in different sectors of the economy. There's no doubt that some of the biggest froth, in my view, went into crypto and went into late stage venture capital. I didn't see that same sort of froth in early stage venture capital. And I didn't see it quite so much in sort of core markets, core publicly traded markets, though, I just gave you some examples of silly stuff, right? I could use examples in the UK too.
Yeah.
Forcing, pension funds to buy gilts at negative yields and stupid nominal yields. Anyway, enough of that. So I think we'll find out over the next several years. And I have to say that, to be, I think we need to be, sort of realistic about this. I may be wrong. I mean, maybe I've been worried about inflation since COVID because I was just so worried about all this money just going out there. But maybe I'm completely wrong. I mean, there are still a lot of people who argue that, the right level of long-term government bond yields, yes, is 2%. I find that incredibly difficult to believe, and we can talk about all the reasons why. But, so as long as there's that debate about where the right level of long-term, nominal yields should be, I think, we should be, we shouldn't just assume that the interest rate environment has completely changed forever, right?
Yeah.
I am acting as if it has, but I don't think we should assume that.
Yeah. And now you mentioned one of the pillars of your investment approach is fintech. On the fintech side, what do you find are the most interesting trends to invest in?
So I think the industry has matured quite a bit. So, if I compare where we are now versus where we were in 2010 or 2015, it's like night and day. So when I first started, I had a big focus on payments, a big focus on lending and making lending part of a consumer or corporate process, right? A big focus on analytics, particularly analytics that would support lending. But there are certain areas that I was very uncomfortable with. One was banking licenses and startup banks, startups and banks. It goes back to my comment about like what startups do really well versus what banks do really well. I did like asset management. I still do for startups, but that hasn't changed. I mean, there's startup, hedge funds and startup asset managers, all the time. But so I still like that. Going forward, now that things have matured quite a bit, the areas where I still see the most opportunities are in payments, in lending, and in asset management. I haven't seen new themes come out of fintech since probably 2017, 2018. But a lot of people sort of tweaking things and taking ideas that have been germinated successfully in the UK and in the US, but more sort of UK, a little bit of Brazil. Brazil has been a good market for innovation. 2 other countries. But as a risk management matter, I just, I can do the UK and US. I can't get my head around some of the other countries. It's just too hard.
And how
And
about
I
something
haven't
like
found.
blockchain? One part of crypto that seemed quite interesting, and people saying this could disrupt, payments and such, was blockchain technology. I mean, is that part of your thesis?
It's okay. So, like when I think about blockchain or I think about machine learning or I think about, artificial intelligence, I consider those as sort of a toolkit, right? And so when do you apply that toolkit? Um, in my personal experience, using blockchain for, bog standard bilateral contracts is just a waste of time, right? Why should you create an immutable record? Like weird, I don't know. It takes a long time, right? There are much, much faster ways to do large, data work. Where blockchain can be super useful is where you have 5, 10, 15 different counterparties all working on a particular transaction. I'm thinking about the banking perspective. And, and you needed an immutable record, right? Because if it's just you and me doing a deal, it's like, that's fine, easy, right? Yeah. But if there's 15 different people who change what, when, and, and sometimes you need for regulatory, legal reasons, sometimes for business reasons, you need an immutable record. And there's 15 or 20 different people all putting stuff into an immutable record. And but it's in there, it's done, right? So if somebody did something wrong, they've changed it, you have a record of exactly what happened. Those situations are incredibly useful. And so, I think, like any technology, you have to decide very carefully, what's the most appropriate application. And sorry about that. My screen is reacting to my gestures. And, not everything is appropriate at all times. I mean, I'll give you a funny little, So when I first took over the technology at Deutsche Bank, I said, so how many different applications do we have? All right. And I got the number. It was too large a number, and we did a lot of good work to rationalize. But then, one of the technologists, the team, very smart guy, said to me, remember, Henry, we don't keep track of all the spreadsheets that people use. But people use spreadsheets sometimes because it's just faster, easier, right? Yeah. It's not always the right thing to do, but it's fast and easy. So we have to just be mindful of when the right use. So I think a lot of the early blockchain startups, they're like, blockchain. I'm like, okay, cool. So what's the product? What's the client? Who's the client? What are you going to do? Right? Blockchain. I'm like, okay. What's the business, man? Okay, you're going to sell the toolkit? Okay, right. So good. So you're in the business of selling a toolkit. So how do you differentiate what you're selling versus what, Salesforce, Oracle, IBM, and 10,001 other people are selling?
And the same applies to machine learning and AI in your view, that it's a toolkit.
Very much so.
Some of those sort of purpose.
Yeah. No. So up until several years ago, I would have argued that we could not use the word AI. We really couldn't. And I kept on saying to people, look, let's use machine learning, because I think that was a more appropriate way to characterize what we were doing. But, over the past couple of years, we've seen some just outstanding advances, oftentimes through brute force, just sheer, ability to manipulate data that gets you beyond machine learning to be able to really anticipate the needs of individual users. So imagine a typical bell curve of, an experience, whatever. Most businesses just aim for, the 80-20 rule. They just don't worry about the far ends of the bell curve. But, good statisticians, with the usual, Bayesian stuff could do a great job. Especially when you started thinking about what's the right curve you want to model. And then we started seeing, really good advances in machine learning and the ability to, figure out based on the data, right? Rather than imposing your own perspective on what the data could look like, using the data to figure out what, to simplify the bell curve look like. Right? To now a situation where the bell curve really doesn't matter because you have so much data around individuals that, that if individual X, right, did Y, then they're probably also going to do Z with, probability of X, right? So, that allows you to be, really very, very tailored in your approach to individual client. And it allows you to just simplify your life. I mean, I've seen a couple of my portfolio companies experiment with adding AI to their processes, and they're getting efficiency gains of 2 or 3 hours per person. And these are relatively high end, asset managers, lenders, people who are, really smart people who, adding, 2 or 3 hours of productivity to their day is a really tremendous, impact on the productivity of the organization as a whole. So I'm quite, optimistic about the broader application of these tools to different businesses. But we shouldn't kid ourselves. I mean, a lot of the sort of segment that I'm focusing on are early adopters, very entrepreneurial people, quick on it, right? How long will this take to get into the, it reminds you of the story about the horse and the tractor, right? It took quite a long time for tractors to, to become part of everyday society. Why was that? Because, they were expensive. They didn't work that great. Horses were cheap. Everyone knew how to use them. It took like a whole series of different events around labor costs and the ability to scale farms. And, all these different things had to come together to make, tractors, economical, scalable, and, useful. Anyway, but the point is I'm quite optimistic over the long term around the application of these tools to different businesses.
Yeah. And now I do know, just a bit of a pivot here. I mean, I do know you've also been focusing on medicine and biotech as well as a theme. So tell me more about this focus.
Yeah, similar sort of concept there. We've seen now I'm not an expert in the space, and I only want to use this as an example of how the world is changing so dramatically. Okay. I think that similar to the way that, you can use new data techniques to personalize customer experiences in the financial space, you can use new data techniques. I'm thinking CRISPR and all the work that's done now in medicine to tailor medicines to individuals, right? And to individual diseases, right? So being able to create a vaccine for an audience of one was impossible, right? But imagine applying the same sort of approach that I took to being able to tailor medicines to, an individual's needs at that particular point in time. And I think you can see that we're going to have, quite a significant step change in the way in which both we anticipate needs going forward as well as cure, diseases that come up. So I'm quite optimistic that we're going to go through quite a significant period of productive, exponential change in medicine and biotechnology. Similar to what we're seeing now in energy and energy use. That's another theme of mine, right? If you remember, oversimplifying it as always, but I'm trying to tell a story, right? It used to be that you had to put the mill next to the stream because the only way you could get the mill to run was the water, right? And we had the steam engine, and then you could sort of, build a factory wherever, right? But then we had electricity, and using electricity meant you had to be dependent on, on a huge infrastructure, grids, this, that, and the other thing. With solar, wind, and the electrification of a lot of our power needs, I think over time, we're going to be able to go to a much more decentralized power grid. This is like a 20-year process. But again, I expect exponential change there as solar and wind has become, particularly solar. Solar is cheap as chips, right? And, if you happen to be, unlucky on the solar side, you're generally pretty lucky on the wind side.
Seeing in the UK, I can agree with that.
Well, no, here I am sitting in Panama. We see solar panels everywhere. And, every time I'm in Northern Europe, including the UK, I see wind and windmills everywhere. Same is true in the southern, in Chile, Argentina, and there's so much wind there. You can use cheap wind power. Some places are best with both, right? You get both sun and wind. But I don't want to underestimate the transition. I think we need to be very, particularly for developing countries, we have to understand that most of the technologies that are easily scaled right now are powered by coal, oil, gas, and that will continue to be the case for 20, 30 years. And it requires just a wholesale rethinking of the infrastructure to get to where we want to be from an electrification perspective. The good news is, if you don't have too much, already invested, you can go straight to the end game, right? So there are certain countries. Panama is a great example. I don't use any telephone lines or anything like that. We went straight to mobile, right? And we in some ways have avoided the necessity to create, huge embedded infrastructure in, telephone lines and physical, telephone lines. And maybe there are certain similarities and certain, lessons we can take away for application in emerging markets on the electrification side.
Now, and we could carry on talking. We'll have to come back for part 2. So I just wanted to round off with a couple of personal questions. One was, what's the best investment advice you've ever received from anyone?
So my partner on the lending side has 2 doozies, which I definitely want to share because these are really good. The first one he said is that financial returns are determined by both the numerator and the denominator. And in short, it means that the price at which you buy something and the price at which you sell something are both equally important, right? So always buy cheap and always sell expensive. And the second thing that you said, which really sticks with me, so true. You never sell anything unless something else is really much cheaper and is much more desirable to have, right? You want to always stay invested. And you have to think that cash is an active investment strategy. You're actively making a decision whenever you hold cash. Those 2 things I think are incredibly important and oftentimes get sort of shunted aside in the way in which people think about things. There are 1 or 2 other tidbits that I would throw in there, and to think in threes, maybe I'll just keep it to 1, and that is keeping everything super simple is important. You just want to have simple themes, simple expressions. Creating complexity, I think, can be a disaster for long-term investment strategy. You really need to focus on clarity.
Yeah. Now, the other one was some of our listeners are young or younger, and many of them will leave university at the end of this year to enter the real world. What advice would you give to them?
I'm a big believer in taking the path less followed. So I would encourage them to think about doing non-standard things, right? Things that are just different, and that give you a unique experience and a unique perspective. I would say that harkening back to my earlier comment, in addition, you should really just focus on trying a lot of different things until you settle into one thing. Because, life is all about figuring out what you really, really like. And if you like it, if you love it, then it becomes something that you're really happy doing. And you're going to do it no matter what, whether somebody pays you or not. Hopefully you'll find something that both you love and somebody will pay you a lot for. But those two pieces of advice, I think, are really important. You don't want to do something because you've been told to do it or because it's a thing to do. You want to find the unusual stuff. And then when you find something you really love, you want to stick to it and do it. And that'll serve you well with life, I think.
That's great advice. And then what are some of the books that really influence you over your career?
I'm a big fiction person, so
Okay.
I have not. Yeah. So generally speaking, I love Kafka.
Okay.
He was great at just pointing out absurdities. They're just fantastic authors. So a number of his books, I really, really like. Those are always very fun to read. On the nonfiction side, I do like reading history. History major, yeah. But and then sort of historical fiction too can be fun. History is really good. I surprise people. I keep on telling them that I'm Marxist, and they look at me like, yeah, I'm Marxist. In the true sense of the word, that economics matter, and what drives big social trends is often driven by what's happening in economies, the macro or the micro level. We wouldn't have the United States, Argentina, Brazil if we didn't have the first and second industrial revolutions in Europe. But we can talk about that.
Yeah, no, that's great. I like that. It's punchy. And just to round off, just a final thing, if people wanted to follow you in some way, is there a way for people to follow your thinking or connect with you somehow?
I generally am quite transparent on my website,
Okay.
so people can pop in. But you've reminded me that I haven't updated my website for a little while. I've been traveling quite a bit, so I'll have to go and add some stuff on board. But if you Google me, you'll see I do quite like doing podcast discussions. I'm oftentimes in the press, so people are very welcome to.
Okay, great. I'll add some links on your to your website and such. So,
wonderful.
With that, it's been a fantastic conversation. I'd love to get you back on sometime in the future as well, and have a fantastic sort of time where you are at the moment in Panama, and also good luck with all of your investments as well.
Thank you very much, Gil. Great seeing you, and look forward to speaking to you again soon.
Great, thanks. Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.